Hi, everyone. Hello, Hugo. Shatin. How are you? Ryan, what's going on, bro?
Yeah, hi Dale, you all right?
Yeah, everything's okay. Someone wants me to play guitar until the opening. That'll be 99 a month.
Yeah, as long as you don't ask me to sing.
Huh?
As long as you don't ask me to sing.
All right, so let's take a look around here. Getting a little bounce back in some of the precious metals here. Still think that, it's going to do some work and fill out a bit. I think we're in the range from 1760. I don't know if we'll see 1680 again. Something that happened yesterday that, is probably meaningless, but we had a nice little turnaround Tuesday trade that did work in NASDAQ on this candle for a little over 120 pips, trying to hold here. This is a very key area. If you see my cursor up here, 14.9. So we're 130 pips away. There's a confluence of a wedge line, of this support line, of a moving average at 14,847. So it's still a bit down here, but this would be one of the first negative things for NASDAQ to do, probably analogous to this 4370 level in S&Ps. And oil giving back some of its recovery here. I still think this looks like a descending triangle. Does not look bullish to me at all. Breakdown is going to measure in the 50s. So be careful with that. And the end is getting a little bit stretched, don't you think, up here, Ryan?
Yeah, possibly. It's run into that 70-80 zone, which is sort of the recent highs up there.
Yeah.
You can see going back into last month or so. As we get towards 111, it's been a sticky point all the way through. We've never got above and held above 111. So you're quite right. It could be starting to, on the FX side, stretch a bit far, because you've got to remember, when you get yield moves and FX following yield moves, there comes a point where the FX technicals are going to assert themselves over the bond move. Bond moves only take the dollar so far before people go, well, that's dollar yen going too far. We're gonna start selling that.
Okay, because the 10-year and the yen, here's the 10-year 4-hour and the yen 4-hour, look pretty identical, don't they?
Yeah, exactly. I mean, the yields are just going and going and going. It's at the point I don't actually think the CPI data might mean an awful lot today in the trend, because every Fed speaker that's coming out pretty much is talking about their tapering. I think the market's coming around to the idea that it's happening, whether it's the end of the year or they announce it by the end of the year, it's happening. So unless the CPI report absolutely craters, I don't think that will change. Hey, Blake.
Hey, good morning, and good morning, guys. I just, listening to what you're saying, I agree with you. Now, I think the conversation has to be, okay, well, we know tapering is going to come, but maybe it's the pace of the tapering, right? Yeah. So if this inflation data is strong, which we pointed out yesterday, I don't think we either beat on CPI or came in line all of 2021 to forecast, meaning that inflation has been rising, and it's been rising at a rapid or more rapid rate than most economists believe. So if it continues down that path, will that change the amount of taper that people believe is coming? I mean, if we're going to start getting tapering by the end of the year, again, I just want to get your opinion here. Maybe the inflation data will matter some.
Yeah, I'm not saying it doesn't matter, entirely to the whole picture. What I'm saying is right this minute, the market sentiment is, bond yields are rising. I mean, last week we were hitting 113 and whatever. Yeah. Now we're up at 137 up towards 140. You know, it's a huge turn. These are huge moves we're getting in bond yields. You know, the bond market is massive, and to have yields moving that far, there's a lot of business going through there. So that, yeah, there's obviously the CPI matters in the bigger picture, but I'm not sure whether today it changes what we're seeing right now, unless it really craters. You know, if it's lower by a couple of pips, you know, yields will probably drop for about 5 minutes and then carry on up. And as you say, you know, and as I wrote last week in a post, you know, it isn't about when they taper, it's how they taper. And you're quite correct. The taper, you know, if they taper 10 billion a month, that's a year before they run it down. If they taper 20 billion a month, well, now you're shortening the timeline. And I think that, quite rightly, as you say, is the next piece of the taper puzzle. But I think the market is like, yeah, we're getting a taper. You know, there's not going to be a taper tantrum. There may be a mini tantrum-ette once we know the pace of it. But I still think we're not going to know that until October, November, perhaps. We'll get the inclination they're taping. We'll get the final details towards the end of the year. That's when the next big shift is going to happen. The next big move's coming. But, you know, it's data. And if there is a big variation, the market's going to move. I think personally, if inflation drops maybe by 3 pips or more, that's potentially, if you get a sell-off in the dollar, that may be one to look at fading, because I don't think this sentiment is turning at the moment.
Sounds good. All right. I didn't want to interrupt you. I just wanted you to clarify a little bit about CPI, because look, it's summer doldrums right now. And if there's anything that might give us a little bit of shock of volatility, this is the day, right?
Yeah, definitely. I mean, I'm sitting in long euro dollar trading into that 117 handle, and I'm sitting 15 pips above, and you know, we've got a big data coming up. So I'm thinking whether I'm going to pull the rest of my orders, you know, maybe scale down the trade a little bit just for that risk event, or even just move my stop that's currently at 1680, just move it well out the way, just to take account of any, you know, volatile moves. You don't want to get flipped out on a stop and then it bounces 50 pips. So yeah, it's a big data point, and you know, we need to take that into consideration.
Sounds good. Hey, Dale and Ryan, just
Yes.
continue on. I'm gonna finish typing what I'm typing, and I'll be there in just a minute.
Okay.
Cool.
Okay. Any questions from attendees? Something that maybe you want Ryan and I to discuss? LZ's looking to build some longs around 109 in the end. 109. So looking for a pullback, if possible.
I just want to, guys, I just want to say, well done.
Stel.
Hey, well done, Ryan. I mean, tantrum-ette, that's a really nice word. Well done. I liked it. I mean, regarding the markets and all that, my view is quite similar to Ryan's. You know, unfortunately, we're in the summer doldrums, and we're waiting for
Labor Day
and Jackson Hole, Labor Day. But you know, if we do get an inflation number which is a little bit further away from expectations, then obviously that's going to bring some volatility. But the main thing is Jackson Hole, and you know, are they going to tell us the extent and the timing of the tapering? Because I think everyone can kind of agree that tapering is coming. They're telling us, like Ryan very correctly said, they're telling us, you know, Fed members already are telling us one by one that it's coming. The question is when and how. So, you know, the market, go on.
Yeah, sorry, Stel. I agree with you. I think Jackson Hole is being made into a bigger event than it's actually going to be. I mean, Powell's not going to turn around at a non-FOMC and say, "Yep, we're tapering in September and we're tapering X billion a month." Yeah, you know, we've got 3 on the voting members. We've basically got 3 members who aren't yet in line with a taper, and that's Powell, Brainard, and Williams. All the others have spoken about taper coming at some point, or they need to do it, or whatever. So you know, they're in the minority now. So I think that most we're probably going to get Powell or someone saying, well, it's got to be Powell saying, yes, in the next few months, we're considering a taper. And I think that's the most we're going to get. And then the market goes, has a little tizzy fit, and then everyone goes, right, September, that's the date. And December, that's the date. We've done this for 6 months.
The goalposts, yeah, exactly.
And again, I have to reiterate something I just said a bit ago, guys. The fact of the matter is we know a taper is coming. So now it's the pace of the taper, right? That's the, ooh, did you guys hear that?
Yeah. Who was that?
That was easy. That was me. You know what I found yesterday is I found my ringy bell. I haven't found my ringy bell in 3 years. We moved. We did a lateral move. We moved a mile down the road, pretty much, same price house, just closer to my kids' school a few years back. And I packed my ringy bell and I couldn't find it until yesterday.
Nice.
All right. I just
Lucky
woke up everybody.
us.
Yeah, lucky you guys.
Our friend Warren here is asking, based on this taper discussion, do we expect markets to run higher even on poor CPI release in 20 minutes? No. I mean, if we're 0.1 away from expectations, or even 0.1, 0.2, I don't think it's going to make a huge difference. But obviously, if it's an outlier number and it's weak, then I don't think. Well,
I believe.
Depends, yeah.
I do believe if the data is weak, we're going to see the markets rip into new highs.
Oh yeah, equities, yeah,
equities will rip into new highs and the dollar will get smashed. We have to continue to see. I think if you're a dollar bull, and let's go talk about the euro, because Ryan's trading it. I know a lot of people are trying to pick up the euro down here at 117, and this may be the best trade of the week right now, is being long the euro. I mean, I think it's a little risky going. Ryan, we just had this conversation. He's like, well, I don't know if I want to pull orders. I want to sit in the trade, because look, this is the 38% retracement of the 2020 low to 2021 high at the beginning of the year. We are at the 38% retracement. It is horizontal support. We all know this is big. And so if the euro, breaks through 117, let's call it 116.80, I mean, we're probably going to go a lot lower. And that is a result of stronger data. But in order for the dollar to move like that, we do have to see continued strength in inflation. And I believe that the market's got to be fully convinced that this inflation data that we're seeing is not transitory, right?
Yeah, 100%. I mean,
yeah,
it could be
oh, go ahead.
Sorry, I was just saying it could be the case. What tends to happen with price action around data points is it pauses. So it can sometimes lull you into a false sense of security. Yields can pause up at this whatever 137 odd. Where are we now? Quick, 137.10. So it can pause here and you think, well, maybe there's a top there. But once it gets over the data hump, if the data is the right way, even by a pip, the market goes, right, we've got over that risk, we'll carry on. And then 5 minutes later, you can see it at 140. So it's very difficult sometimes to trade data. But I think you're right. I think as I said yesterday, the big price risk is a big miss.
We got the same, Ryan, 2 months ago, if you remember.
Yeah.
2 months ago, we got a weaker inflation data than the previous month to that. And then everybody was like, oh, there it is. Inflation peaked. And then we got last month the biggest month-on-month inflation data in 15 years or whatever. So
exactly.
Yeah.
So let me for those of you that don't want to take on the risk ahead of the data, which I completely understand. I mean, I'm long dollars, but I've been long dollars. So it's, I'm going into the data being long dollars for the last, week and a half, 2 weeks, and, long dollar Norway, from this 870, low 70s support, and long dollar MEX, from down here at if you're ForexAnalytix subscribers, you see the active patterns in play for the last, couple of weeks. So you guys kind of know where I'm positioned as far as the dollar goes. I don't care about going through this data right at this moment in time because I've already booked some profits. But if you're like, you're positionless and you are looking at today's data, you're like, well, what do I do here? I can, the way I would play the euro at this point is pretty simple. If you don't want to step in front and just roll the dice, which I don't think is a wise decision right at this moment, is if we break below 1680, the data was strong. You know that it's strong data. The market is now pricing in more tapering or, a higher pace of tapering by the end of the year. The dollar is going to strengthen. Stocks are probably going to come under pressure. We break below 1680. We stay below that for the day. I'm going to make the assumption we're making a move towards 116. The flip side of that conversation is, let's say the data comes in weak and everybody goes, holy crap, maybe it is transitory. Now, don't forget we have producer prices tomorrow as well. But people go, oh, well, it's probably, this is going to be transitory. The Fed's right. Hell, we might get tapering at the end of the year, and it's going to be a little amount. Maybe we won't even get tapering, until the first January of 2022. I don't need to be long dollars right now. If we get a move back above 117.50, then you have a couple of things that happen technically. A, you get a false breakdown. Oops, you get a false. Did I just draw that correctly? I didn't hear. You get a false breakdown here. And then you have a big possible double bottom setup. So I think above 117.50 is bullish and below 116.80 is bearish. And right now you happen to be in what we like to call or reference as no man's land. So, I think it's a risk trading the euro right now, but I think the euro's got the best potential at the moment. So
yeah, I agree. Can I just give something quickly on the
please,
on the numbers,
please,
on the numbers
yes.
themselves? When I trade inflation or look to trade inflation in normal times, my rule of thumb is 2 points. So if inflation misses by 2 points or more, whatever side, that's when the market moves. Anything within 2 points, not really a market mover. So what I would say, exactly what you're saying.
So so explain 2 points being point.
So let's
zero
so the CPI's CPI is expected at 4.3. Okay, so if it comes in at 4.5, 4.1 in normal times, that's not really anything to move around on. So what I would say for this reading, because we've got that much volatility in, if you're looking for a soft reading, it's got to be less than 4.0 on CPI on core CPI. And less than 5% on CPI. If we get something in those numbers, then it's going to look like a bad number. On the flip side, a good number has got to be above 5.5, 5.6% on CPI, above 4.5, 4.6% on the core. Anything in between that, so it's quite a wide margin. Anything in between that, if it's 4.4, 4.5 on the core CPI, you might get that break of 1700 in the euro. But I'll be worried that it's going to really continue and maybe it's just going to flush the level before it bounces again.
So Joe, if you take what Ryan just said into consideration of the technical picture that I just gave you with the euro, unless the inflation data is super weak and it comes in below the numbers that Ryan just said, a sustained move above 117.50 may not happen. And then a sustained move below 116.80, unless that, the CPI comes in, what'd you say, closer to 5% or, 4.7, 4.8%?
Yeah. Well up.
Yeah. Some in that neighborhood, then, even if we get a probe below 116.80, maybe it's not going to stick. So,
yeah.
So
you've got to match up the actual, the variation in terms of what the price move might be.
That's awesome. Now, hey guys, just for those of you that are just tuning in, thanks for joining us. We do these webinars every day. They're free here at the F.A.C.E webinar, and in about 10 minutes, the data is going to come out. You're going to see that data via data flash. It's going to be released here. We're going to quickly look at the charts. And then Dale's going to give you an interview. And Dale, you got who do you got from Lions Fund Management coming?
Dana.
She's always a pleasure to listen to. I thought it was one of those nice ladies that you always bring on.
Just in case you ask for an interview, his sex.
Oh, okay. Yeah. Okay. Dana, you always bring on such ladies with such nice voices that I end up sticking around for a while.
Oh,
I like to listen to them.
Yeah.
Oh, if it's a dude, I'm leaving. No, I'm just kidding. But just for those of you that are,
very good.
yeah, and I'm sure I've heard him before because I know you've brought him in before.
Yeah.
But I just want to let everybody know that we, here on the FA.C.E webinars, Dale brings in people from all through the industry, whether they're analysts or technicians or whoever as guests. So make sure you stick around for after the CPI data release, and make sure you subscribe to the YouTube channel so you can listen to
Get some good ideas
interviews
from some of these people.
Oh yeah, that you do. What do you call it, Dale?
Intelligence gathering.
Intelligence gathering. So very good. Now I'm going to really quick go over the chart of the day that I had yesterday, which is the sterling, which is the cable basically. And notice how we're bouncing from flag support. And this is an important chart because I think that if the data is weak, this is going to be one of the best trades to be short the dollar, is going to be long sterling, because the cable, just if you look from a couple of weeks back, we broke below the 200-day moving average. We broke below. Whoops, I didn't want to move that. Shoot, I'll put that back. I'll put it back just like that. So we broke below the 200-day moving average. We broke below horizontal support. Everybody, myself included, thought, oh, double top. I got caught short down here, by the way. And I lost money as it bounced back to the breakdown point. I tried to short it. It took me for like 30 or 40 pips. Anyway, how many people got caught short? Well, look, false breakdowns usually lead to breakouts. So we got to move higher, stalled at the 618 retracement, which is basically 140. We've pulled back to the 38% retracement. I'll show you guys the 38% retracement of this move. That's also flag bottom. So if we get weak data today, the sterling should challenge 139 and possibly break 139 and head back to 140. And if this flag pattern plays out, then we've got a long way to go. I think if we get weak data, I know a lot of you guys are going to be trading the euro. Me, I'm going to get long with sterling. So that's my trade. And that was my chart of the day yesterday, which is on our blog. You can see it's the chart of the day yesterday. This is the free part of ForexAnalytix, so you guys know that we post there. But do you guys have any opinions? I know Ryan, you have been. Whoops, I didn't mean to do that. You've been looking at the sterling a lot through the euro sterling. And so do you have any opinions on how the pound is working right now?
Yeah, we got the break in euro sterling I've been waiting for through the 85, 84, 80 level. It didn't really kick on. We've been down to 50, which was a bit of a grind. And we've got a lot of option activity there today in play. So I agree with you 100% about cable. I think that's the one to go on the dollar story, and it will probably ease euro sterling down because cable will go further than euro dollar will go, just because there's additional vol in that pair. So if euro dollar goes 20 pips, cable is going to go 40 pips sort of thing.
Right.
I agree as well, guys. Sorry, I didn't mean to interrupt.
Yeah, go ahead. No, go ahead, mate.
I agree, and I've been saying for ages, I think 83 and a half, there's a big zone, support zone in euro pound, and it's like a magnet. If you look at the weekly chart, it goes back to mid 2016. It's been tested quite a few times, and it's bounced every time. It's kind of, I've been saying this for weeks, maybe months. I think we need to go. Not years, but after remember, after the Brexit agreement in December, and I really think that Europound wants to get to that level before it makes a decision, and that's where I'm going to get long. 83 handle, probably towards 83 and a half. I'm going to start getting long.
I mean, those are the spike lows here at the end of 2019, yes. 2020.
They go back to 2016 as well. I mean, it's very important, that level. If you go back, you'll see there's more.
Yep, right there.
Yeah. So That's huge. And, when you get levels like that, the market kind of wants to test them again and again until either they break or, it snaps back. So I think
they're the sort of levels you want to trade, big juicy ones like that. I mean,
exactly.
The 85 level was similar. It's a big level going back years,
Yes.
And that's why I'm a bit disappointed that it hasn't really kicked on through. I'd have liked to seen a break of 85, and seeing us around 84 at the moment, but it hasn't really happened. And maybe it's summer, maybe it's just not got the impetus to do it. But we'd all love a perfect world when we're trading.
Right,
it's not even bouncing. That's the thing. It looks pretty heavy to me, and it just feels like these are the lows. The 85 was a big level. People maybe are trying to or have tried to play a counter trend long, and now they're sweating a little bit. So I think I really think we're going to get to 83s, 83 and a half or something like that.
So LZ makes a comment that there may be a technical reason for dollar index to reach for 94 before it's weaker. Hey, look, I look at the dollar index and I see it as all sorts of bullish. I mean, and this is the reason why I'm actually long US dollar Norwegian krona. I'm short the crown, and I'm short the peso right now, is because look at the dollar index. I mean, this is a triangle. We're broken above that. We clear these highs. So in other words, if the euro breaks 116.80 roughly, I mean the extensions just take us to 94, which he was just pointing out. This is the 94 level. And I mean, if you look from longer term, like you take the high here from 2020. Let me just pull up a retracement really quick. So, the 94 is just above that is the 38% retracement, which is also a lot of previous lows, previous highs. And I think this is very doable in the dollar index if the dollar continues to rally. One of the other things that I continuously point out, but I have to, is remember going into 2021, the trade of the year in currencies was to be short the dollar because the euro is going to 130 and 140 again, and we've seen the exact opposite this year. So just remember that the dollar could have a lot further to go just to squeeze. So anyway, just wanted to bring that up. We have about 2 minutes before data comes out. We will be pulling up the data flash. Yeah, sorry, thanks. It's I got up a little early this morning to jump on a call with Steve and Stelios, with our partners, our brokerage partner, Pepperstone Securities, which we've done business with them for the last, was it about a year, a little over a year. The problem is they're in Australia. We're all over the place, so we have to get up extra early to talk to those guys sometime. Anyway, the dollar yen. The dollar yen, we should be focused on a little bit too. The dollar yen's, I think this is strengthened a lot with yields. And how do you feel about yields going into this this data, Ryan, Stelios, Steve?
Anybody? Well, they're creeping higher. US yields, that is.
Yeah.
Bunds have been quite resilient. Again, I see this. I'm not a day trader, so I see this as just for the moment. It's just noise. We went down to 115. Now we're up to 132. It's in the grand scheme of things, we're still not breaking out either way. So, for me, yes, we are looking a little bit more hawkish. So yields are going up, but nothing to do yet for me.
All right, Ryan, do you have any other views of yields here?
Yeah, just about the same. I think dollar yen is all about 111. If we can get and hold above there, then we're potentially going to take another leg up. If we can't, we stay in the box, unfortunately, and that means sort of 109, 111 range.
Okay, and one of the other things I want to mention before the data comes out, which should be in 30
30
seconds.
seconds. Yeah.
Yeah, equities are still very strong, guys. We're holding at 44.30. I'm not bearish equities until we get below 43.25. So 4325 in the S&P. Right now, we're in a bullish wedge. Market's still very bullish. We're just right. I mean, we're within, 10 points of all-time highs in the S&P. So data is about ready to come out. This is Data Flash. This is included with ForexAnalytix subscription. It runs about as fast as Bloomberg in many cases. So, to get your data releases quick. Oh, there goes the euro. Weak data. I'm going to have to close out of my
core CPI as expected. And
but look at year over year.
CPI unchanged. It's beat expectations by a pip.
Mixed. I think it's mixed, the data, right?
It's pretty much in line. Core CPI dropped to 4.3% from 4.5%.
5.4 year on year with a 2% target.
It's transitory. Come on.
Data.
Get with the program.
Yeah, I mean, look, stocks are going to rip to all-time highs, guys.
Of course they will. They do no matter what.
Yeah, I just closed out my dollar longs. So just to let you guys know, I just pulled them off. So I'm going to go deal with that right now because those are around for a little while. I'm going to pass it over to you guys because I need to go update the ForexAnalytix site. You guys have a great day. Dale, have a great interview.
Thank you. Hey, Dana, welcome back to F.A.C.E, buddy. It's great to have you back. It's been too long.
Yes, thank you, sir. Can you hear me?
Yeah, I got you loud and clear.
Okay, excellent.
Yeah,
great to be back.
How have things been going, Dana? Relentless bull market, the big debate over inflation being transitory or not. I'm really interested in hearing what you have to say at this juncture. You want to share your screen here with that little green box?
Sure. All right. Yeah, right now, basically not, we're mostly equity guys. So we've got our risk model that basically measures risk in the equity market, whether we want to be invested or not, and then where do we want to be concentrating our investments. But we do obviously track relative strength across all financial assets.
Okay.
I think we're in a holding pattern.
Is this what you want to show, Dana? It's like a blank. Yeah.
Yeah, I'll get into some stuff.
All right. Okay.
But equity market, I heard you guys talking about the strong equity market. Some areas of the equity market are strong. If you look at, so here's our favorite broad market index, the value line geometric composite, which tracks the median stock in the market, which basically been going sideways since the spring. Even the large cap averages have been hitting new highs. So we've seen after following the election last year, we had a monster rally, phenomenal breadth. Everything was going up. About 2 months ago, it did like an about face, and we saw breadth just fall off the table. So the recent string of new highs has not been accompanied by very strong participation among the broad market of stocks, which is our concern right now. You can see the median stock still trading below that 50, maybe setting up another down leg. So it got so bad. For example, we did a study where over a 30-day period, recent 30-day period, there were 10 days on which the NDX, the NASDAQ 100, closed at an all-time high on negative breadth. That was the most.
I saw that. Yeah.
That was the most days over a 30-year period of all time. It broke the previous record, which was early 2000. So whenever we get these types of breadth divergences, there's always some kind of a reckoning, at least in the short term. So we think there's going to be some more sideways, some more consolidation, some more downside. Doesn't mean those areas that are working, that are hitting new highs, can't hit some further new highs. But I think there's going to be a reckoning first, some more corrective action before more of a sustainable new up leg, which I think is coming, because technically most things are still in fine shape. I think just in the near to intermediate term, we're going to see more of a corrective action. Just to put,
wouldn't this be a good time for a bear raid with thinning market conditions in August before Labor Day?
Yes, seasonally it sets up perfectly as well. So there are a lot of things lining up for that. But these types of thin new highs never lead to a sustainable a sustainable move to new highs. But again, we think after this corrective action, we do see more of a sustained new up leg. I mean, you look at the S&P 500, nothing wrong with that chart, obviously.
Yeah.
After the other thing that needs to be reset a little bit is investor sentiment, still a little bit too complacent. So we'd like to see sentiment reset a little bit of spike, more of a spike in fear and a reduction in complacency. If you look at the VIX, and the VIX on the Russell 2000 kind of diverging here as well. Here's the VIX holding up a little bit higher, even as the S&P hits new highs. So, and then on the Russell 2000, RVX still holding up
a bit above the lows from
last
year.
Yeah, hitting higher lows. So
can you explain to me, Dana? I don't know how many times I've asked this question. Why hasn't the Russell, and I know it's made some progress here recently, trying to fight its way to new highs, but what's behind the relative weakness in Russell compared to the rest of the market? Is it because people see more economic weakness or vulnerability in domestic stocks and multinationals? What do you think the reason is?
Yeah, you know me, Dale. I'm never looking for a reason for anything.
Okay.
We just analyze what is happening and what's likely to happen. So that's all we care about. Why it's happening, I don't know. I will tell you this. Like I said, we expect a better markets after some further corrective action, because this is not unhealthy. You see the sideways action in the Russell since like February. We had just a monster rally following the election last November. This sideways action is not that unhealthy, and it's not unusual. So I think a little bit more corrective action, even retracing to that 23 retracement since the COVID crash down closer to 2000 in the Russell perhaps, and then and then another up leg potentially. So this is not, I would say the breadth divergence is very unhealthy and suggestive of further corrective action here.
So is it distribution or consolidation before another leg up?
Exactly. I mean, that would be our read on the situation, because typically we had such good breadth, almost breadth thrust like in the post-election move, that that is highly suggestive of eventually new highs to come. But I think given that breadth divergence, there's going to be some more reckoning and ramifications to the downside first, and then a new up leg.
Okay. See what I'm sure I know you look at all different sectors, Dana. The metals really took it on the chin Friday and Monday as well, and it seemed like the gold shares actually held up better. They were underperforming when gold was going up, and seemed to not be hit as hard when gold got clipped. Views? Are we setting up some type of divergence here for nibbling at golds?
Right. So a similar, on a different, perhaps different duration, similar story in the precious metals market. We think of another case of a good rally. All right. So we trade only ETFs for our clients. So we're not looking at the gold market. Here's GLD. Okay.
Right.
We had a monster rally from 2015 to the highs of last year. Basically similar highs as the all-time highs from 2011. So this action we're seeing over the last year or so, not unhealthy, not unusual, consolidating that move that we saw over the prior 5 years, right? So eventually, after some consolidation, as you would say, we see another up leg, okay, to the bull market. We see a breakout and a new up leg. Similar story if you look at the XAU, Okay, so index of gold and silver mining shares. It's a little bit different than the GDX, but if you look at the XAU, didn't get up to the all-time highs, but what did it do? It retraced that 61% from those all-time highs in 2011. So over the last year, we've been consolidating. I think also again here, especially if gold and the GLD breaks out, then we get a new up leg here in the XAU, in the GDX. Let me find the GDX, which we trade. Similar story. See, we bounce right to that 61 retracement, almost to the penny, right? So after some consolidation, GLD and gold break out to the upside, and I think gold miners do as well. In the near term, we're in a little bit of a tough spot technically. We zoom in a little bit. Here's so here's the silver miners, SIL. Bounce obviously under a whole bunch of resistance here. We sold the rest of ours into the bounce earlier a couple weeks ago, getting into some support right now on SIL. So for a trade, we'd be buying some here in the 38 range on SIL. Same thing with, I guess I didn't open up SLV. So silver, the silver ETF, similar story. We ran into resistance a couple days ago on silver. Let me pull it up if I can find it here. So silver bounced up the other day right into that 24 resistance, sold the rest of our silver there. We'd be buying some here today around 21.5 for a bounce. Okay, might not be the low, might continue down, but again, looking at consolidation here as well around the 38 retracement from the SLV from that after that move from the crash last year. Looking for consolidation, looking for eventual new up leg there. So short term, still in consolidation for the precious metals complex. Still some short term resistance and some challenges here, but again,
so everything's pretty much the same, Dana. And listening and watching that, we had that everything rallied strongly from last fall into the spring or summer and consolidating near the bottom of some of these ranges, but you're expecting continuation to the upside after this.
That's right. Yeah, a lot of
everything.
A lot of things. So here's crude oil. Is the GSCI
you're
crude
a mind
oil
reader.
index.
I was just going to ask you about that. Okay.
All right. So we rallied, off of that COVID crash. Here's the GSCI crude oil index, right up into those highs from 2018. So what we're seeing over the last few months, not unhealthy, not unusual. See some consolidation. Eventually, I think we do hit new highs in crude and put another up leg in there. But same thing. So we've been in this two-way market, as we've been calling it, since the spring, so to speak. And it's basically a trading market. Go for, as we've been telling people, go for singles, not home runs. You got to be selling the rips as well as buying the dips. So don't get too greedy. And it's basically a trading market. Don't expect many breakouts or breakdowns at this point to be sustained. So basically just trading. Another around if you go around the world, some interesting action in Europe. So for the entirety of my investing or money management career, which is about going on 30 years now or so, basically have been avoiding Europe because it's never looked that good. Still kind of.
What are you looking for? DAX?
I'm going to pull up the stock 600 index in Europe, which is avoiding me at this point. I'll pull it up here. So
is it dollar related?
I don't think so, because here. So since the 90s, since I entered my investment career, basically the SOX 600 has been going sideways. Finally broke out, above all those peaks just recently. The interesting thing
what,
is,
Dana? What great patience you had to wait 30 years to get long.
exactly.
You know,
Uh,
that really is excellent patience.
Yeah, and if you look fundamentally, I mean, things are in shambles over there. They have been ever since
Yeah.
I started in this business. But again, you don't argue with price. And about the best looking charts around the world are the European markets, which I can't explain. That's just how it is. So Europe, the stock 600 going nuts to the upside. You mentioned the currency effect, where it does come into effect, I think, is in these the U.S. based ETFs that track the European equities.
Okay.
So we do see after you look at this Vanguard European ETF VGK, the ticker symbol. So this one was doing great off of the low at around the election. Just recently, it's been lagging because of the kind of the
Delta
pullback in the euro. So we've had we've got lower highs going there. But if you use that hedged currency ETF, HEDJ is the ticker symbol, you can see that hedges off the currency risk. This one's going to new highs, just like the stock 600. So if you look around, around Europe, and one area in Europe that gets overlooked for some reason, but has been working for actually the last almost a decade or so. You look at some of these Northern European indices, which is much different story than core Europe, the DAX and France and whatnot. You see like Switzerland been hitting new highs for a while. You go to Finland, been hitting new highs for at least the last half a decade. So Northern Europe, about some of the best looking charts in the world right now as well, even as core Europe is starting to break out and look good as well. So again, there's no fundamental reason for me to like Europe, but they are among the best looking charts in the world.
Okay. So last Friday, after the NFP 10-year yields, I believe the day before, had retested the 113 level and then reversed strongly with nice follow through this week. To me, that looked like the end of the consolidation after the big run up to 178. I'm wondering what you're thinking here.
Yeah. Going back, we zoom out a little bit, going back hundreds of years, there's very reliable, approximately 60-year cycle in interest rates. Okay. So that was due to bottom like 10 years ago. So maybe the intervention, central bank intervention, to feed into some of the narrative has forestalled that bottom in interest rates and kind of prolonged the depressed run in the lower for longer type of move in interest rates. We think maybe last March was finally the low, and we think interest rates go up for a long time, for many years, many decades even, perhaps, and much higher. Obviously, it's not going to be straight up. So we had that nice bounce off of the lows from 2020, right? This move, again, like many markets, like you suggested, maybe just a little bit of a retracement, some consolidation ahead of the next up leg. So did move up right up to some of the levels we were looking at in the 10-year. Right now up into some resistance here around that 137 level, perhaps, but maybe a low right here. I would say the next level, once we are out of this consolidation, next level we're looking at is around 215 on the 10-year and the 30-year. Similar story, ran right up, I guess in March towards that 245, 250 level. We're looking at consolidating right now. In short term, we would not be pressing our shorts here into a bounce into that call it 2% to 205 level, some resistance here in yields in the 30-year yield. Once this consolidation is over, though, yes, I think we do test that 250 level again, and then the next leg up would be up towards closer to that 350 level eventually. But yeah, after again,
and markets like and all the markets you talked about previously, Dana, continue to advance despite rates going up. In fact, except for maybe some mega growth, I believe they're the, you spoke to the negative divergences in NASDAQ, that perhaps the FANGs and some of those names are the most vulnerable to higher interest rates.
Yeah, I mean, that's what the narrative is, right? And yet we see, okay, we've been two of the sectors that we've been heavily concentrated in. So we're not big among diversifying unless those areas are working. So the areas we've been concentrated in lately have been healthcare and technology, because those are the ones that are working best despite the rising rates. I guess just recently we've seen obviously rates come in, which has maybe helped perpetuate the recent run in technology. But again, we're going to concentrate in the high relative strength areas, which recently has been technology and healthcare. So you look at here's software continues to run to new highs. IGV, the ticker symbol. This one, cybersecurity, CIBR, the ticker symbol, running to new highs. These are vulnerable here in the short term, only because if we do get a reckoning and more downside action based on the breadth divergences, obviously these are the areas that are extended. XLK, technology. I mean, these I spoke of Europe. Domestically, the tech sector has some of the best charts in the world. Obviously, near term extended a little bit. Here's healthcare running up to new highs like day after day. Here's the internet, one area in Techland that's not extended. Could buy it right here. FDN, the ticker symbol on internet, still hitting higher highs in the intermediate term, so nothing wrong there. So yes, vulnerable perhaps in the short term, especially if we get some sort of reckoning, like I said. But overall, healthcare and technology continue to be two of the best sectors. I would say also another interesting thing, if you look at interest rates bouncing back over the last week or two. If you look at financials, which had been bouncing, obviously they like it. The interesting thing is financials are back up to, if you look at the XLF, back up to testing their former highs already, even as yields are obviously well off their highs. So maybe this bodes well for a further upside in yields, but setting up for another up move, we think, is XLF. So if we get a little bit of a pullback here, which might happen given some of the numbers, the economic, So I'll pull back down towards that upper 36 range, 37 range on XLF, sets up a nice entry point perhaps in XLF. And if you look at the broker dealers, continue to run up to new highs. So this one, IAI, the ticker symbol here, has been working great for us. Another one in the biotech space that is setting up again for perhaps a new up leg. You look at IBB, the biotech ETF, after a prolonged correction after hitting those highs in February, coming back up to test those highs. Looking for a pullback here to about 165 or so on IBB, sets up a great entry point for maybe another leg up. So healthcare, technology, it still look good. In the near term, financial setting up again.
Buy breaks, stay long the world. Dana Lyons. Right?
Yeah. I mean, right now going for singles, trading this range in most assets. Buying the dips and selling the rips, take some profits. Don't go for the home runs right here, but in the long term, we see in more up legs eventually in most of these assets once this consolidation is over. So it's kind of a frustrating market if you're not trading it at the moment, but further up legs that come. I think one more, I'll tell you one more big time potential around the world, if I can find this. So last time, I think last year we talked about it when I was on one of my wild card markets last year. I think it was in 2020, was Taiwan. So we had going into 2020, I'll cut that off. We had about almost a 30-year sideways move that was testing the top of that move. You can see we did get that breakout, and we're seeing a monster move to the upside. That's consolidating now. I think the next one in line is Vietnam. I'll show you one more interesting chart. Would be Vietnam maybe setting up for that next major opportunity in some of those smaller cap or smaller market emerging markets. We had that look at this cup and handle kind of going back to 2007. Did get a breakout this year, pulled back, tested that breakout level, might get another test of that breakout level. But if you look at that breakout on a long-term scale, I mean, this is setting up for maybe massive upside here on the order of that Taiwan breakout. So you're looking for a good speculative opportunity. Look at Vietnam. So there is a ETF here in the U.S.
Maybe before I watch another rerun of Platoon, I'll pick some up.
Well, I mean, there's
one of my favorite war movies.
Yeah. I mean, you ask me about reasons and fundamentals, and
it's so amazing, you know, when you look back in history. I mean, look at the Olympics and what was happening 70 years ago, and it's amazing. So Taiwan is going to be the beneficiary of perhaps the restructuring and slowdown in China. You have any opinion on what the Chinese government has been doing, and is that an avoid for you? Anything in China?
China is one of the markets that we don't like. One of the few.
I found one. Took me the whole interview to find one.
Well, I mean, here's the Shanghai Composite. I mean, there's not a whole lot to like there. Sideways at best, lower highs. Still hitting lower highs right now. We would be selling it right here, the Shanghai Composite, hitting resistance. If you want to short it, go for it. This is one that we would be selling. Most of the markets we'd be buying the dips in the intermediate term. This one is the one we would be selling rallies into resistance. So yeah, you did find one, the Shanghai Composite we'd be selling right here.
It was great talking to you, Dana.
Yeah, likewise. It's always a pleasure. Sorry, I think we had a mix up. I got the time wrong last time, so
that's okay. For that. Well, but you know,
always a pleasure talking to you.
Yeah, I really appreciate your looks and your discipline. I knew you when you came in here. I kind of had an idea of what you were going to be saying, but I always like to look at your charts and get your perspective. And thank you, my trading warrior brother, for sharing your work with us today.
Yeah, thanks for having me on. It's always a pleasure.
Best way for people to reach you would be Twitter or your website. Which one?
Let me go to my website.
Okay, Anthony Konekis said a great interview. Thank you. Monica saying thank you. So
let me see if I can.
Dana is an RIA. His firm does manage people's money in the equity market. So there you go.
All right. So we have our core business is money management. So we do have an RIA. We also have this subscription service for traders, active traders who are do-it-yourself traders, the lion's share of it. So I give a pre-market video and strategy video before the market every day. So it basically tells you and tells our members what exactly we're looking at and what we're looking to do. So it's really an all-access view of what we're doing. So lionsharepro.com is where you can find that. And we also have a couple other, if you go to About Us, we've got some other services. One for 401k investors is my401kpro.com. But for our management business, jlfmi.com, you can find more information. And then on Twitter, J Lyons Fund Management. You can find us there.
Invest with the heart of a lion. Dana Lyons Fund Management.
You should be my marketing guy.
Anyway, I like that. So thank you very much, Dana. Great to have you. I'll be in touch, and we'll keep you in the rotation. Okay, buddy?
Sounds great. I'd be honored.
All right. Dana Lyons, everybody.
Take care.
All right. So that's a wrap. See everyone for tomorrow's Thursday session. Remember, join the team in 15 minutes for the morning edge. You get to check out the bias chart and ask questions of Blake and the whole team. Thank you for your attention today, everyone. Remember, don't just count your pips, count your blessings. You're welcome, Sinatra. Adios. See everyone tomorrow.